Welcome to The Explainer. Today we're talking about a company that's pretty much becoming the secret engine room for the entire smartphone industry. Yeah, I'm talking about Dixon Technologies. We're going to break down their strategy, which is, well, it's got analysts forecasting some absolutely explosive growth. So let's see if the hype is real. Okay, let's just jump right to the number that has everyone talking. 50%. That's a projected 50% annualized growth in earnings per share every single year, all the way through 2028. Look, a number like that isn't a typo, right? It's a massive signal. So we got to ask, what in the world is driving this?
Seriously, how does any company pull off that kind of growth? What's the secret sauce? Well, that's what we're here to figure out. Let's get into it.
So at its heart, Dixon is a leader in something called electronic manufacturing services, or EMS. Basically, they build electronics for other big companies. But the phrase you really need to hear, the one that gets investors excited, is re-rating candidate. What that means is the market is basically waking up and realizing, hey, we've been undervaluing this company. It's that moment when everyone looks past the short-term noise and sees this huge fundamental shift happening.
And pillar number one for that potential? It's their massive role in putting together the very smartphones that we all use for some of the biggest brands on the planet. All right, now this might look like just a bunch of numbers, but here's the key takeaway. You've got these huge domestic clients, right, like Xiaomi, but then look over here at Motorola. That's a massive export business, and that's so important because it means they're not just playing in one market. This client mix, it gives them a safety net, a kind of natural hedge if one market slows down. That is a seriously smart move.
You see, every client here plays a specific strategic role. Motorola? That's their global powerhouse, their ticket to the export market. Xiaomi is all about massive scale. They want to be their #1 manufacturing partner, period. And then there's Vivo, which has this incredible potential catalyst. If their joint venture gets the final government green light, boom, a whole new revenue stream could just open up. So they're not just getting bigger, they're building a fortress.
But look, just assembling more and more phones, that's not the whole story. Not even close. The real magic, the part that truly juices their profits, is this brilliant concept called backward integration.
So what does that fancy term actually mean? Well, for Dixon, it's pretty simple. It's about making more of the crucial parts that go inside the phone instead of just snapping the final case together.
And honestly, this analogy just nails it. Think about it. Anyone can cook a meal in a kitchen, right? But the real control and the real money, that comes from owning the farm that grows the vegetables. For Dixon, making these high-tech components is owning the farm. It gives them total control, and more importantly, it lets them keep the juicy, high-profit margins that come with those parts.
So here it is, their roadmap, and it is just a masterclass in strategy. Step 1, they absolutely mastered high-volume assembly. Check. Now they're on to steps 2 and 3, bringing in the manufacturing of high-value parts like camera and display modules in-house. And these aren't just any old parts, you know? These things carry fat, double-digit profit margins. The end game? To control 40 to 45% of the phone's total component value. And that completely transforms them from just a low-margin assembler into a high-margin component powerhouse.
And listen, this isn't just some nice theory on a PowerPoint slide. Nope. When you actually stack Dixon up against their competitors, the numbers prove they are already pulling away from the pack.
This table right here, it basically tells you everything you need to know. It puts Dixon head-to-head with its main rivals on the key financial stuff. Now, don't get lost in all the numbers. We're going to zoom in on the two that really, really matter.
Okay, first up, return on equity, or ROE. All this means is how good is a company at making profit from the money investors put into it. By 2028, Dixon's ROE is projected to hit over 32%. And as you can see, that's more than double its competitors. That's not just a little bit better, that is a completely different league.
And here we are, right back to that headline number. See, that projected 50% earnings growth? It's not happening in a vacuum. It absolutely towers over the competition. This chart makes it crystal clear. This isn't even a close race. Dixon is just accelerating away. Okay, so you've got this incredibly powerful story. The big question for any investor is, what does this all mean for the future? Let's break down the potential scenarios.
Analysts are basically looking at two main paths forward. There's the base case, where they grow at only an incredible 48%, and that just assumes they keep on their current path. But then there's the bull case, the one that pushes them over that 50% mark. And that's what happens if they execute perfectly on that backward integration strategy while also bringing new clients into the fold.
So, when it's all said and done, it comes down to weighing the opportunities against the risks. The upsides? Huge. Getting that final approval for the Vivo deal or landing another big client. Those are major catalysts, but there are risks, for sure. You have to watch out for them. Relying too heavily on any single client. And let's be real, pulling off these complicated joint ventures is tough. It's where the best laid plans can go wrong.
And that leaves us with the million-dollar question, doesn't it? The plan is brilliant. The numbers are frankly staggering. The opportunity is massive. On paper, Dixon has everything it needs to become an absolute titan of electronics manufacturing. The only question left is, can they execute?